Hello traders, this is Blake Morrow with ForexAnalytix, and you're listening to the week ahead video for February 24th, 2019. Hope everybody's having a great weekend, and I hope you all have a great week ahead in trading. But before we get into the charts and what we're looking at in the week ahead, let's talk about a couple of housekeeping items. First and foremost, if you're going to be in the New York area, March 10th through 12th, make sure you join us for the Forex Expo. We're going to be there. We're going to have a booth. We have Steve from Athens, Greece coming in. We have Grego Horvat from Slovenia coming in. We have Joe Perry, who's local to the area, who will be there as well. So make sure you attend and let us know that you're coming, because we are setting up a little get together for ForexAnalytix subscribers and ForexAnalytix traders, listeners of the show. So come on and visit us. Now, also really quick, I just wanted to go over that if you haven't tried ForexAnalytix, well, try it. It's only $1 for 10 days. $1, $1 US for 10 days. But when you try it out, make sure you download the mobile app. So this way you have all of our analysis on your person, on your phone, on your tablet PC, and make sure you jump in our chat rooms. Our chat room is really, the software obviously and the analysis is the platform, but the heartbeat of the program is really our community. So once you're involved in the chat community, or in ForexAnalytix, make sure you click this button up here. It says go to chat room, and then you can get inside of the chat where everybody's at, and chat with all of us, myself included. I'm in there the majority of the day. All right, so let's talk about oh gosh, one last thing before I get into the charts. One last thing. We also have and I mentioned it 2 weeks ago, and if you go to the webinars and you go to our playlist right here, as you see the playlist, you go to the next week's week ahead video, go to this one right here. It says next week's preview, February 10th 2019 trading setup special. You can see what my trade setup looks like. We're doing a giveaway. So if you guys want to be involved in the giveaway, all you have to do is submit your trade setup, a picture of your trade setup, and we're going to select a 1 grand prize winner, 3 runner-ups, and one of them is going to be a random winner as well. So that means you don't necessarily, anybody can win, is what I'm trying to say. And for the 2 grand prize winners, you're going to get ForexAnalytix gear and a semi-annual subscription, and the 3 runner-ups are going to get 1 month free of ForexAnalytix as well. And we'll put you on the blog and talk about your setups as well. Our team will comment, so it'll be really cool stuff. So make sure you get involved. All right, let me go ahead and get over to the charts, and let's talk about the week ahead. So everybody should know this, that the markets right now are in very tight trading ranges. Okay, and one of the things that I was looking at the end of last week is the euro dollar volatility. For those of you that know me, I trade for Gelos Capital out of Greenwich, Connecticut, and so the guys over in that office, we were talking about Mr. Gelos actually brought this to our attention. This is the euro dollar volatility, and you can see how low volatility has been. And this is let's go a little bit further out. Let's go to daily 5-year really quick, and you can see just over the last 5 years, I mean, we're trading at very low, historically low volatility levels for the euro dollar, and that is problematic, because as traders we really benefit from higher volatility in currencies. And when volatility is as low as you can see right here, it makes it more difficult. And you can see it in the currencies. I mean, you can see it in the in the euro dollar specifically. I mean, we're in tight trading ranges right now. Now regarding the euro, I've got to stay bearish while we're below this 38% retracement. So let me point out the 38% retracement. You can see the fib level from here. That's the high that we reached in January of this year, okay, to the low, the spike low. 38% retracement, you can see it at 113.60. It comes in at, well, 113.60. So as long as we remain below that, now you might say, well, Blake, we got above it and it failed. Yeah, I mean, look for closing prices. Daily closes below that 113.50, and as long as, or 113.60, as long as we stay below that, the trend is lower. That means the dollar, the risk is for a higher dollar. Okay, if we break above 113.60, then that might take us to the 618, which is 114, 38, which then is at risk of, a much bigger move, 200-day moving average type of thing. But while we're below the 113.60, I have to remain bearish. Now, it's not just because it's a 38% retracement, it's also because it is a long-term trend line that we broke. You can see this black trend line here. Excuse me. And I'll zoom out and you can see that black trend line. We broke it and we've been basically hovering below it. Now, does that make me want to run out and just short the euro dollar right now? No, I don't think so. Not at least not at this very second. Well, the market's closed right now, but what I would be looking for is maybe going into Monday, Tuesday, if we can get a rally back at 113.50, maybe looking for a manageable risk reward short up there, because if we get we start trading at 113.80, then the risk is that we're starting to build that momentum going the other direction. Now, one of the things that makes me a little hesitant about shorting the euro is the pound, and it's not because let me just say that the pound is extremely buoyant right now. We closed back above the 200-day moving average, but this is an important week for the cable and for Brexit developments. So the Prime Minister May is standing by her commitment to hold another meaningful vote by February 26th, or at least looking to extend the amendable motion on the 27th. All right, so that's later on this week. And the risks of the Brexit negotiations extending past the deadline is because I think most politicians in the UK know that a hard Brexit is not it's not going to be good for anybody. All right, so extending the negotiation period seems possible, and that could quite possibly fuel further gains in the cable. And I think that's a risk to dollar bulls right now. So excuse me, if the pound makes a move above these trend highs, and you can see we put up a little hammer, we're back above the 200-day moving average. If the pound moves above this like 131.10, will that be enough to actually spur movement or a move above the 131, 131.70, 131.80? So that, I think, is the risk to being bearish the euro dollar or being a dollar bull at this moment. Okay, and it is tricky. I'm not gonna take away that it's not tricky. The pound is holding up pretty well. Now, if you turn your attention to like other currencies, you go over to like the Aussie, for example. The Aussie, we've had a nice bounce off of this triangle support, but the Aussie looks at risk of breaking lower. Okay, the Aussie does, and the China-U.S. trade negotiations are, they're ongoing, but the Aussie is not. And if you look at the rest of the market, especially like the S&P and equities, you look at the tone of the broad markets, they look like they've priced in a favorable China-U.S. trade deal or at least something's going to get done. The Aussie, on the other hand, it's really been underperforming. So I know the Aussie bounced off of like this what could be viewed as a triangle support here. But if the Aussie starts breaking back below 70 cents, that's going to be a pretty bearish event for the Aussie dollar, in my opinion. Now, I almost failed to mention something about the euro, and I want to take you back over the euro dollar for just 1 second. As a matter of fact, I'll use this chart that I can draw on. The euro dollar, longer term, okay, you'll notice the big 618 retracement. If you go to the low of, this is right here at January of 2017 to the high of February of 2018, the 618 retracement comes in basically at 112. One of the risks, in my opinion, is if the euro starts breaking below, and let me grab this little support zone here. We start breaking through that support zone through the 112 level. That's going to be a very bearish event for the euro, especially if we take out the 618 retracement. That opens like a, in my opinion, it opens like a trap door down here, through 110 and quite possibly even lower. Okay, so that's one of the other things that I wanted to talk about. That the euro is, even though we're on the underside of this trend line, we are hugging some pretty key support down here, and I failed to mention that when I was talking about the euro earlier. I just wanted to bring that up. A couple other things that I think we should all be watching out for, and then I'm going to talk about the events that are happening on the week ahead. We talked about the euro volatility being low. You should look at this chart. This chart right here, where is it? Okay, of the dollar yen. Look at, okay, look at this. You want to talk about low volatility? Look at that. That's the dollar yen volatility. Again, it's not conducive to those of us that are trying to make money in the markets trading it, because when volatility is that low, it's the market's obviously in a tight trading range, and you can see it in the dollar yen. Now, low volatility like that doesn't last forever. It's unfortunate because usually you see these lower periods of volatility during like summer months of trading or near holidays. But you'll notice that the dollar yen really very tight trading range for the last couple of weeks. 110.50 is support, 111 is resistance. I think we got to let the dollar yen break out of that range before trying to take advantage of the dollar yen. Also keep in mind that it's really not following risk appetite. When you have the S&P up near its highs, the dollar yen has really failed to follow through. So I think the risk is lower right now. So I wanted to talk about that. One last currency pair I just wanted to show you is the dollar Canadian. The dollar Canadian, I was looking for an inverted head and shoulder pattern, hoping that we'd get some weak retail sales on Friday. The dollar Canadian actually just reversed from trendline resistance here and rolled over. So I think you can rule out the inverted head and shoulder pattern here. Let me delete this, because that's not really doable at this point, which is fine, because what I'm looking for is the dollar Canadian to actually dip down towards 130. This 130 level where we got some minor support coming through here about 131, but I'd really like to see a dip to like 130.50, which is more of like a channel support. So somewhere down here below 131 I think is going to find some pretty significant support for the dollar Canadian. Also keep in mind that the dollar Canadian, we do have data coming in next week with I almost said Canada with Canadian GDP at the end of the week. So let's talk about some of the events that are coming up on the week ahead, and let's go this week. And you can see all the data through here, but let me just give you some of the key talking points. So Sunday night we're going to have New Zealand retail sales. That's going to be pretty important for those of you if you're trading the Kiwi dollar. The Kiwi is also in a tight triangle here. We are above the 200-day moving average, but resistance is going to be closer to 69 cents, maybe even above that, and it supports 67.50, maybe 67. So again, very tight trading range, very tight ranges, and low volatility in most currencies. But we do have New Zealand retail sales on Sunday. On Monday, the Bank of England Governor Carney is speaking. On Tuesday, we have the UK inflation report hearings. Now, that can be a market mover. It can be a market mover for currencies. So just keep in mind that we do have inflation report hearings on Tuesday morning. On Tuesday, we also have consumer confidence. So the Conference Board consumer confidence numbers for the U.S. Fed Chairman Powell also testifies. That's the Humphrey Hawkins testimony, so we might get some more indication about what to expect from the Fed going into the next couple of months as far as data dependency that seems like that we're closely monitoring. On Wednesday we have Canadian CPI. On Wednesday, we're also going to have the second day of Fed Chairman Powell testifying as well. On Thursday, we have U.S. advanced GDP numbers. Now, that's going to be an important read for the U.S. economy. Is going to be the advanced GDP numbers that are coming out. The market is starting to price in a weaker U.S. economy, so think about that as that approaches. And then Friday we're going to have, like I said, Canadian GDP. We also have PCE in the U.S. and personal spending and income, and ISM manufacturing data before next week's. I believe next week we'll have non-farm payroll, but one of the other things that's happening on the data front, if you look on Friday we have a bunch of PMIs coming out, European PMIs, and what you're going to notice here is a lot of the numbers are dipping below 50, and that's contractionary numbers. So as not only the U.S. but the global economy continues to slow, those numbers that are starting to weaken, the PMI numbers, they're starting to grab the attention of traders globally, and I think that the equity markets might start taking notice at some of the growth data coming in a little weaker. Anyway, guys and gals, if you found this video beneficial, and if you think it's going to be beneficial for your week ahead, make sure you click the thumbs up button on YouTube, and then also click the bell icon when you're on YouTube. That means that you're going to be notified once we upload new videos every day. So if you miss our free face webinars and interviews that Dale Pinkert does for the community, and once the recordings pop up, you won't miss any of them. All right, and my name is Blake Morrow. You've been listening to the Week Ahead video, and I really hope you have a great trading week this next week. I'll see you on the face webinars tomorrow. Have a great one. Bye bye.